I couldn't figure out what the fourth one was going to be.
Yeah.
So I just did it in 3. So I went 33%,
We went
33%,
3.
33%.
I think did
And
4.
I pressed it and it went through and I was like, great. And when she woke up, I'm like, I really did it. She's like, what? I'm like, I put the 100,000 in the market. She was like, what? I'm like, remember I told you. And you know what? I never looked back. I never looked back. I said, I studied it. I understand it. I think that's important when you're investing, understanding what you're investing in. And I had conviction in it. It's like, I'm going with it. Let it go. And I did. And it's probably one of the best decisions I've ever made. And yeah, it's up there. It's top 5.
Yeah.
Because in 10 months, that investment, each one of them now, remember I put 33,000, 33,000, 33,000 in each one of them. And they all appreciated by an average of 1,200%.
Wow.
What's up, fam? Welcome back to JRuss TV. If you're new to my channel, hit that like, comment, subscribe button. We cover all things business, investing, and self-improvement content. Something you're interested in, just consider liking, subscribing, all that good stuff. Returning to the channel. Appreciate you tuning back in. We're back with another banger video. Why I believe you should only hold 5 to 10 stocks max in your stock portfolio. This is something I see a lot of beginner investors, even experienced investors, smartest people in the world, can do all the research, all the data, all the analytics, all that type of stuff. But they over diversify their portfolio too much where they dilute themselves. They dilute your money. Now, for myself, if you're new to the channel, I do have a stock portfolio, public stock portfolio that I share with you guys. My Robinhood portfolio, which is right here. $5,000 all time. We're up 100% all time returns in this stock portfolio. I do have my personal portfolio too. If you do want to track this, go to Blossom. Right here is my personal portfolio. Similar stocks, in all honesty. If you want to follow all my trades, all my plays, all my buys, my sales, follow me on Blossom, link below. Follow me on X as well, link below. I do post a lot of content on there. Been trying to ramp up a lot more. But as you can see here, my top 3 positions here is AMD, Nebius, and Zeta. And as you can see here, that makes up, let me add that up real quick for y'all boys, 28 plus 18 point, what's that, 7 plus 16.2. That's 62% of my portfolio, is of my net worth is in these 3 companies. A little more than half. And then I have some other positions here that are, good quality companies. But it's best to put all your eggs in one basket and watch that basket very closely. Now, I've been doing this before I heard of Drunken Miller approach, but that's where I got that from. I did a little more research into him. He's an investor, well-known investor, and this is one of his strategies he had for a while. So I'm gonna go ahead and play this video for y'all.
Talk about your investment philosophy and why, you got those types of results. How did you do it?
Well, my idea of risk control is a little non-conventional. I like putting all my eggs in one basket and then watching the basket very carefully. I think, I don't know what they teach at Marshall, but at most business schools they teach, I think, a lot of nonsense called risk-adjusted return and diversification. As a money manager, if you look at a normal portfolio, most people will make 70, 80% of money that year on 2 or 3 ideas, even though they'll have 30 or 40 things in their portfolio. My concept was to put into those 2 or 3 ideas that I had the most conviction in. I was also lucky to travel across asset classes. So I traded commodities, currencies, bonds, and equities. And it gave me the discipline. If I didn't have a good idea in equities, I was happy to have no equities. Or the same thing with bonds. So when you have a quiver with a bunch of arrows in it, you can usually find something to put a lot of money into. The only other thing I'd say is too many investors look at the present. The present is already in the price. You have to think out of the box and sort of visualize 18 to 24 months from now what the world is going to be and what securities might trade at. What a company's been earning is ridiculous. It doesn't mean anything. What you have to look at is what people think, what a company's earning, what people think it's going to earn. And if you can see something 2 years, it's going to be entirely different than the conventional wisdom. That's how you make money. My first boss used to say the obvious is obviously wrong. If you invest in conventional wisdom, you're going to lose your butt.
Yep. So basically what he's saying is put all his eggs in one basket and watch it very closely. As you all can see with my portfolio right now, with the public portfolio, I have 1, 2, 3, 4, 5, 6, 7 positions. I think the sweet spot is between 5 to 8 positions. Anything more than 10, you're over diluting yourself. I really want to get smaller. If I can get to 6, that would be sweet. 6, 7, you know what I mean? But I'm still like, I still want to stay a little diversified a little bit. But as you can see here, my NVIDIA is 13% of this public portfolio. Meta is 7.14% of this portfolio. AMD is 45% of this portfolio. So half of this portfolio is like AMD, essentially. And I got AMD going to 1,000. SoFi, small, 3%. Zeta's a big chunk of this portfolio. Zeta's 17% of this portfolio. So between AMD and Zeta, that's 55, 62% of my portfolio, of this portfolio, is in Zeta and AMD. I do have some Nebius, which I think is around 10-ish. Nebius is around 11%, so that's 62. Plus that, which is 73% is AMD. So AMD, Zeta, and Nebius is roughly 72% of my portfolio, of this portfolio. But the reason I want to do that is because those are some of my best ideas right now. Or they were my best ideas in the past, as Stephen, what's his name again? Stanley, as he was saying, you want to focus on where the puck is going. Where the puck is going. AMD. We was buying AMD. We were buying AMD in the hundreds. We were buying AMD 170s down to 119, down to 120, down to the $80, $98. This was a year ago. We was buying AMD. A year, he said 16 to 24 months out. You know what I mean? Is when you want to start seeing where the puck is going. I knew this is where it was going. I knew agentic AI was going to be coming. I knew inference was going to be taking over soon. The market just didn't see it yet. Now I'm up 300% on AMD. Patience. Now let's look at the Zeta, my second biggest position. We were buying Zeta, last July, $15, $20, $17. Now it hasn't fully taken off where I think it's going to be yet, but SaaS has been getting beaten up this past 6 months. Software as a service. Zeta is a software company because the thesis is that Claude, OpenAI, these LLMs are going to create software that's going to put every software business out of every software company out of business, which is false. Companies that have proprietary data, such as Zeta, they are the disruptor in this AI revolution. Maybe like an Adobe's getting disrupted. Zeta is a disruptor. Market hasn't fully seen that yet. I'm looking a year and a half out from now. I think software will be a big winner. But that's another reason why. Nebius, AI infrastructure. This is where the market is currently because we're getting crazy returns. Year to date, we're up 171% on this position. It's a big position in my Blossom portfolio as well. But this is where the puck is now. This is where the puck is going to. I think CapEx is increasing. Go watch my last video, few videos I did on CapEx spending it's not stopping. And where's that going? Nebius, AMD, you know what I mean? So this is why I'm a big believer in you should have no more than 5 to 10 positions in your stock portfolio because you dilute some of your best ideas. If I would have focused on 20 stocks last year instead of focusing on AMD and Zeta, my portfolio may not have I know for a fact I would have not gotten these good returns. AMD is almost 50% of my portfolio because I concentrated in AMD because I had a thesis and I believed in it. You know what I mean? If I would put that over 10, 20, 30 stocks, I would not get these type of returns. If you're trying to become a millionaire by 65, cool. Over diversify 10, 30, 20, 30 stocks. When I said 10, 20, 30 stocks. If you want to become a millionaire before you're 40, 30, in your 20s maybe, you need to be very, very concentrated in 5 to 10 stocks. My sweet spot is 5 to 8 stocks because you're going to over-dilute yourself. You're going to over-dilute yourself if you do anything more than that. I'm telling this from experience. Now let's show this next video of Bill Ackman. He's another well-known investor.
So tell us a little about your portfolio. Why so few names?
So for a bunch of reasons. I mean, I've always had the view that, why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And, I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns. And it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about, we're getting an awful lot of attention for a pretty high profile situation that's struggling. But I think there's, it depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. I mean, if you look through the Forbes 400, wealthiest people in the world, most of them made their fortune in one business or a portfolio of 2 businesses. Very few made it in a portfolio of 100. So it's that. And the other benefit, it allows you to run a much simpler investment firm. We have an 8-person investment team. If we had 30 names, we couldn't manage that portfolio the way we do with a small team. By having a small team, you can hire better talent.
There's actually an argument that some people are now making that, buying the index or buying diversified funds have had much better returns than buying, those hedge funds that have, a very specific smaller portfolio approach like yours.
I haven't seen that article. I mean, I think we've done very well relative to any index alternative, certainly.
So,
I mean, it depends on how you judge us. I think if you judge us on a 90-day basis, I have no idea how we're going to do relative to an index. But I think this is a strategy that over time should earn a meaningful premium over, any kind of benchmark, or you shouldn't give us your money.
Yeah. And usually this investment philosophy, does it take a week?
Yep. That's another good point he made. You can't even follow 20, 30 companies. I don't know how people are doing this much research. It's hard keeping up with the companies I have now. Especially during earnings seasons. You're putting thousands of dollars, 5 figures. I'm at the point now where if I'm really considering making a position, I want it to be 10% of my portfolio. I want the mass. I want thousands in it. You know what I mean? I'm trying to, especially the amount of research that you do. You want to be paid handsomely for your research, So the guys that got 20, 30, 50 positions, how are y'all doing research on all these companies? 5 to 8 stocks is my sweet spot. I'm gonna finish off with my boy Troy off of Earn Your Leisure. He had a great testimonial that I've been resonating with. He's one of the partners of Earn Your Leisure. It's a stock investment channel podcast, and he's just sharing his story of how during the pandemic, they took a chance. They went to LA. They bought a big B&B. He'd been doing research on the market. He'd been locking in. He'd been studying, and essentially he told his wife, "I'm doing I'm doing it. I'm confident. I'm putting $100,000 in the market." Changed his whole life.
Out onto your point, and so when we go a bit forward in your story,
Yeah.
and we go around that period of the pandemic, there is a moment where you were telling me that you were in LA,
Yeah.
and you guys are like shooting content. This is during the pandemic,
Yeah.
and you wake up one morning
Yeah.
and you tell your wife that you're going all in.
Yeah.
Can you share that story with people?
Yeah. It changed my life. So Earn Your Leisure, we started in 2019. By March 2020, obviously the pandemic happens. People are home, can't go outside, so they're consuming content. We had a year's worth of content of figuring out what people could do with their money, whether it was, start a new business in entrepreneurship, invest in real estate, rent machines, truck, all the things. We became a gumbo soup for people. And that just intensified in the pandemic. At the time, we had tried an episode with our brother Ian Dunlap, who's now our partner on Market Mondays. And we created a weekly show about investing. And so what was brilliant about it is that we hadn't seen it, right, other than CNBC or Bloomberg, but nobody would talk like us on those network television stations. And so there was an opportunity, right? We can decode the matrix, we can listen to what they're saying, and we can, decode it and give it to our audience in a way that they can understand. And so as I'm teaching, this is just like a lifelong skill. If I'm going to speak about a topic, I better learn that topic. And not only learn it, I better really grasp it and understand it so I can teach it, right? Like I can't get out there and not know it. I didn't come from a business background. I have no financial degree. Like none of that. So I better learn this. And so I would teach myself every week and ready for that show. And then in June of 2020, we were like, look, this virtual thing is cool, but we got to get back in person with people. And so Shadi was like, and Mike were like, yo, I got an idea. Let's just go to LA and let's live there for a month. Like, I got 2 kids and a wife. They're like, no, we'll get a big house. We'll all live in a house.
Yeah.
Took a risk.
Like 16 of us in this huge house.
Took a risk. He took a risk, man. He took a big risk.
Living there.
I love it.
Still shooting the shows, still learning, getting up every morning, still reading, going to the beach on the weekends. It was great. And I got to a point with my studying that I felt really comfortable. I said, okay, I'm going to do something drastic. And, the market was opening at 6:30 a.m. Pacific time, 9:30 Eastern. So I'm up at 4 in the morning, reading, getting ready for the day. And I tapped my wife on the shoulder, I'll never forget. And I said, look, babe, I'm going for it. She said, what does that mean? I'm like, I'm going to put $100,000 in the market. And she said, okay. And went right back to sleep. I was like, all right, that went better than I thought. And so I went downstairs. No one's up. I'm sitting at the table and I'm looking at the plan I'm going to draw up. At the time, the market had pulled back to a nice level. I'm like, I'm going to put this in some ETFs, exchange traded funds, which is like a basket of companies in a specific sector. And I still got the picture of it. It was SMH. It was X, which is a semiconductor ETF, NVIDIA, Broadcom, AMD, all the way inside. XLK, which is a technology ETF, and Apple and Microsoft were the leaders in that, and XLY, which is consumer discretionary ETF. I think Amazon and maybe Google were inside of that at the time. And I said, all right, how are we going to do this, Troy? I was like, no, let's not get 3, let's get 4. And with the 100,000, we'll put 25,000 in each, and that'll be great. And I'm like, now you just got to do it, right? You told her you're going to do it. You said you're going to do it. Now you got to do it. And when the market opened, I said, okay, you've never spent $100,000 on anything, but you're going to do this. And I just like, yeah, I'm going to do it. I'm going to do it. Let's go for it. And so I couldn't figure out what the 4th one was going to be.
Yeah.
So I just did it in 3. So I went 33%.
We went 3.
33%.
I think did 4.
And I pressed it and it went through and I was like, great. And when she woke up, I'm like, I really did it. She's like, what? I'm like, I put the 100,000 in the market. She was like, what? I'm like, remember I told you. And you know what? I never looked back. I never looked back. I said, I studied it. I understand it. I think that's important when you're investing, understanding what you're investing in. And I had conviction in it. It's like, I'm going with it. Let it go. And I did. And it's probably one of the best decisions I've ever made. And yeah, it's up there. It's top 5.
Yeah.
Because in 10 months, that investment, each one of them now, remember I put 33,000, 33,000, 33,000 in each one of them. And they all appreciated by an average of 1,200%.
Wow.
Does that teach
Oh,
you?
sorry, no, I didn't mean to cuss.
Most people in the school thought he had no idea what money was or how to manage it or invest. He turned $100,000 into roughly 1.3 million.
Wow.
In 10 months.
Yeah.
And I never looked back. I never looked back.
Look, man. Good game. This is why I'm concentrated. He didn't put it into 10, 15, 20 companies. He chose 3. He chose 3. You know what I mean? I say 5 to 10. I think 3 could be even better if you really concentrated. Now, if we go back to my portfolio, I showed you all the vast majority of my portfolio, AMD, Nebius, and Zeta make up about 60% of my portfolio. You add Palantir, we at 70%. That's concentrated, guys. But I trust my conviction. I've done the research. I'm continue to do the research. I believe in myself, and I have a pretty solid track record of of hitting multi-bagger companies. Pretty solid track record of hitting multi-baggers. AMD, we got a 3.5x. Palantir, we had a 2x. NVIDIA, we had a 1.5x. Nebius, that's pretty much 100% a 1x. I just been dollar cost averaging up. That's another video, sneaky game. Hood 60, Zeta 15. I see this again 100% soon. Like I said, guys, focus on your best ideas. Concentrate it. Don't over dilute yourself. If you have conviction and you did the research, I think you should be a little bit more concentrated if you're looking to make wealth sooner rather than 65 when you retire. JRUS TV.